You know that moment when you're finally making decent money, but somehow you feel broker than when you were making $15 an hour? Welcome to your 30s, where your income goes up, but so does every single expense you never saw coming. One minute you're celebrating a promotion. The next minute you're staring at a mortgage application, a daycare bill, and a retirement calculator, wondering who decided that adulthood needed to be this expensive. Your bank account is getting pulled in 17 different directions. And somehow, you're supposed to maintain your sanity through all of it. Today, we're building a roadmap, not a judgment, just a path forward. Here's something nobody warns you about when you hit your 30s. Everyone talks about your 20s being the time to figure things out, make mistakes, find yourself, eat ramen, all of that. But your 30s? That's when you realize you actually need to have figured things out already. The safety net of "I'm still young" disappears. The excuses stop working. The clock starts ticking louder. The financial decisions you make during this decade will either set you up for a comfortable future or leave you scrambling to catch up for the next 30 years. No pressure, right? I'm not here to make you feel bad about where you currently stand. Maybe you're crushing some of these goals already. Maybe you're looking at your bank account and wondering if you should just give up and become a professional dog walker. Either way, these milestones aren't meant to be judgment calls on your life choices. They're road signs. They're here to help you navigate what can honestly be a pretty overwhelming decade. Let's get into it. The first major money milestone you need to hit in your 30s is eliminating all consumer debt. And yes, I'm talking about getting to zero, zilch, nada, the big donut. The only exception here is your mortgage. Everything else needs to go. Credit cards, student loans, car payments, that random loan you took out to buy furniture 3 years ago that you're still paying off. All of it. I know what you're thinking. That sounds impossible. My student loans alone could fund a small country's GDP. Here's why this matters so much. Your 30s are your prime earning decade. Your salary is likely higher than it's ever been, and it's probably going to keep climbing. The last thing you want is consumer debt acting like financial quicksand, dragging down every dollar you earn. Think about it this way. If you're paying $400 a month in credit card payments and another $600 for your car loan, that's $1,000 every single month that could be going toward building wealth instead of making other people wealthy. Over a year, that's $12,000. Over a decade, that's $120,000. And that's not even accounting for what that money could have grown into if you'd invested it instead. Your 30s are also when life starts getting really complicated really fast. Maybe you're dealing with increased responsibilities at work, trying to manage a household, possibly raising kids, and for many people, this is when aging parents start needing more support. Having consumer debt hanging over your head during all of this is like trying to juggle flaming torches while riding a unicycle. Possible maybe. Advisable? Definitely not. The second milestone is achieving an excellent credit score. And I mean excellent. We're talking 800 or higher. I can already hear some of you saying that credit scores don't matter if you're not planning to borrow money, but here's the reality check. Unless you're planning to pay cash for your house, and let's be honest, most of us aren't, your credit score is going to determine how much that mortgage costs you. Let me put this in perspective with some actual numbers. Let's say you're buying a $400,000 house. With an excellent credit score, you might qualify for a 6.5% interest rate. Over 30 years, you'll pay roughly $511,000 in interest. Now, if your credit score is just slightly worse, not terrible, just not excellent, you might be looking at 7% instead. That seemingly tiny 0.5% difference means you'll pay about $558,000 in interest over the life of the loan. That's almost $50,000 more for the exact same house, just because your credit score wasn't quite as good. But here's where it gets really painful. According to lending data, one late payment that's more than 30 days overdue can drop your credit score by as much as 180 points and stay on your credit report for up to 7 years. Imagine going from a 780 credit score to 600 because you forgot to pay your credit card bill 1 month. One mistake, $50,000 in additional interest over the life of a mortgage. The good news is that maintaining an excellent credit score isn't rocket science. Pay your bills on time every time. Keep your credit usage below 30%, ideally below 10%. Don't open new credit accounts unless you absolutely need them. And whatever you do, don't close old credit cards unless they have annual fees you can't justify. Your credit history length matters. The third milestone is building a bulletproof emergency fund. In your 20s, the standard advice was 3 to 6 months of expenses. In your 30s, I want you to think bigger. We're talking 6 to 12 months of living expenses. Maybe even more if your income is variable or you're self-employed. Why the increase? Because your 30s come with way more potential emergencies. Your house decides the water heater needs replacing at the worst possible moment. Your kid needs emergency dental work. Your car breaks down, and of course, it's something expensive and complicated. Your aging parents might need help with unexpected medical bills. Or maybe, and this is the good kind of emergency, an incredible investment opportunity comes along that requires quick action. Having a well-stocked emergency fund isn't just about financial security. It's about having options. When you know you can handle whatever life throws at you, you can take calculated risks that might pay off big. You can negotiate from a position of strength at work. You can help family members when they need it. You can sleep better at night knowing that a surprise expense won't derail your entire financial plan. The key is keeping this money somewhere it can earn decent interest but still be easily accessible. A high-yield savings account is perfect for this. You're not trying to get rich off your emergency fund. You're trying to preserve your wealth and maintain flexibility. Now let's talk about retirement. Specifically, the milestone that scares most people. By age 40, you should have 3 times your annual salary saved for retirement. According to recent data, the average income for a 40-year-old in the United States is around $62,000, which means you should have roughly $186,000 saved for retirement by the time you hit the big 40. Before you panic, let me put this in perspective. If you start with that amount at age 40 and continue contributing consistently, retirement calculators suggest you could have over $2 million by the time you're 67. That's the power of compound interest working in your favor, but only if you give it enough time to work its magic. Here's what's really important about this milestone. It's not just about the money itself. It's about giving compound interest decades to work for you. Every year you delay seriously saving for retirement is a year of potential growth you're giving up forever. If you're behind on this goal, don't despair, but do get serious about catching up. You still have 25 to 30 years until retirement, which is plenty of time for compound interest to work. But the math gets harder every year you wait. If you're spending this entire decade focused on one retirement milestone, consider increasing your contributions before you turn 40. Bump up that percentage every time you get a raise, every time you switch jobs, every time you get a bonus. The difference between saving 15% of your income versus 10% might seem small now, but over 25 years, it's the difference between having enough money to retire comfortably and having to work until you're 75 because you didn't do the math earlier. Now let's talk about something that separates the wealth builders from the wealth pretenders. I call it lifestyle inflation immunity. Your 30s are prime time for what economists call lifestyle creep. You know exactly what you're talking about. You get a raise, so suddenly you deserve a nicer apartment. Your bonus comes through, so obviously you need a fancier car. Your income goes up, and somehow your expenses magically rise to meet it. The result? You end up with the same amount left over as when you were making $30,000 less. I have friends in expensive cities making 6 figures who are somehow always broke. They're driving expensive cars, living in apartments that cost more than most people's annual salaries, and eating out every single night because cooking is apparently beneath them. Meanwhile, they're complaining about not being able to save money. It's like watching someone pour water into a bucket with holes in the bottom and wondering why it never fills up. The secret weapon against lifestyle inflation isn't deprivation, it's automation and awareness. Every time your income increases, automatically direct at least half of that increase towards savings and investments before your brain has time to dream up new ways to spend it. Got a $5,000 raise? Great. Automatically increase your retirement contributions by $2,500 annually. Your future self will thank you, and your current self won't even miss money you never had the chance to spend. Now for something that might sound morbid, but it's actually one of the most loving things you can do for your family. Getting your estate planning sorted out. I know, you're thinking you're way too young to worry about this stuff. But if you have kids, a mortgage, or significant assets, you need basic estate planning documents in place. This isn't about planning for death. It's about planning for life's unexpected curveballs. What happens if you're in an accident and can't make decisions for yourself? Who takes care of your kids if something happens to both you and your spouse? What happens to your house, your retirement accounts, your life insurance? Without proper documentation, these decisions get made by courts and bureaucrats instead of by you. The good news is that basic estate planning isn't nearly as complicated or expensive as most people think. You can get started with simple online tools for basic wills and powers of attorney. Sure, if you have a complicated financial situation or family dynamics that would make a soap opera jealous, you'll want to work with an attorney. But for most people, having something is infinitely better than having nothing. Now for a milestone that financial advisors rarely talk about but might be the most important of all: investing in your health. Before you roll your eyes and click away thinking this turned into a fitness channel, hear me out. Your health is your greatest financial asset, and your 30s are when you either build that asset or start watching it depreciate. Think about it mathematically. The average American spends over $300,000 on healthcare during their lifetime. If you can reduce that by even 20% through preventive care, better nutrition, regular exercise, and not doing stupid things like smoking, you've just saved yourself $60,000. That's not counting the income you don't lose due to sick days, the career opportunities you don't miss because you feel terrible, the quality of life improvements that come from actually feeling good in your own body. Your 30s are also when your metabolism decides to take an extended vacation. I used to be able to eat anything without gaining an ounce. Now I look at a donut and gain 5 pounds. It's like my body is playing some kind of cruel joke on me. But here's the thing. Developing healthy habits now, while you still have some metabolic flexibility, is way easier than trying to fix decades of damage in your 50s. This doesn't mean you need to become a fitness influencer or start eating nothing but kale and quinoa. It means finding sustainable ways to move your body regularly, eating food that actually nourishes you most of the time, getting enough sleep, and managing stress before it manages you. The money you spend on a gym membership, quality food, and maybe a trainer is nothing compared to what you'll spend later trying to fix preventable health problems. Now let's talk about kids' education, assuming you have or plan to have kids. This is another milestone that can feel overwhelming, but small steps now make a huge difference later. College costs have increased at twice the rate of inflation for the past 30 years, and there's no sign of that trend slowing down. The average cost of a 4-year degree at a public university is now over $40,000 per year when you include room, board, and other expenses. For private schools, you're looking at closer to $70,000 annually. I'm not saying you need to fully fund your child's entire college education, but starting early gives compound interest time to work in your favor. A 529 education savings plan is specifically designed for this purpose, offering tax advantages that can significantly boost your savings over time. The money grows tax-free, and when you use it for qualified education expenses, you don't pay taxes on the withdrawals either. Many states also offer tax deductions for contributions. It's like getting a discount on your kid's education just for planning ahead. Even if you can only save $50 or $100 a month, starting when your child is young means that money has 15 to 18 years to grow. And if your kid ends up not needing all the money for college, you can transfer it to another child. Use it for yourself for continuing education, or even roll some of it into a Roth IRA under new rules. Options are good. Let's lock this in with a quick recap, because your 30s are busy enough without trying to remember all of this. 1. Kill the debt monster. Zero consumer debt except your mortgage. Every dollar you pay in interest is a dollar not building your future. 2. Get an excellent credit score, 800 or higher. That tiny number can save you $50,000 on a mortgage. 3. Build a bulletproof emergency fund, 6 to 12 months of expenses. Your 30s come with bigger emergencies. 4. Hit the retirement milestone, 3 times your annual salary by age 40. Give compound interest time to work. 5. Develop lifestyle inflation immunity. When your income goes up, save half before you spend any of it. 6. Get your estate planning sorted. Wills, powers of attorney, healthcare directives. It's not morbid, it's love. 7. Invest in your health, your greatest financial asset. $300,000 in lifetime healthcare costs is no joke. 8. Start a 529 for kids' education. Even small amounts now grow into real help later. Here's what I want you to take away from all of this. Your 30s don't have to be a financial disaster movie where you're the star of your own tragedy. These milestones aren't meant to overwhelm you or make you feel like you're behind some imaginary schedule that everyone else seems to be following perfectly. They're meant to give you a roadmap. Pick 1 or 2 of these milestones that resonate most with your current situation and start there. Maybe it's finally tackling that credit card debt. Maybe it's opening that high-yield savings account you've been procrastinating on for 6 months. Maybe it's setting up that 529 plan. Small, consistent actions compound, just like your investments. The beautiful thing about being in your 30s is that you still have time to course correct if you're behind on some of these goals. Sure, it would have been nice to start earlier, but beating yourself up about past financial decisions is about as productive as trying to drive while looking only in the rearview mirror. You're going to crash. Look forward, drive toward where you want to go. So here's what I want you to do. Pick 1 milestone from this list, just 1. Write it down, then take 1 action toward it this week. Not next month, not when you have more time. This week, 1 small step. If this video helped you see a path forward, hit that like button. It helps more people find it. And subscribe if you want more videos about navigating your financial life in your 30s, 40s, and beyond. Not the fantasy, the reality. Now I want to hear from you. Drop a comment and tell me, which of these milestones is your biggest priority right now? Is it killing the debt, building the emergency fund, catching up on retirement, or something else entirely? Be honest, be specific. Let's fill the comments with real plans. Maybe your comment will inspire someone else to take action today. I read them. I'll be in there. Let's figure this out together. Thanks for watching. Start where you are. Build from there. See you in the next one.